In the world of finance, what appears under the spotlight is often just theater. When the United States launched its trade war against China in July 2018, imposing a 25% tariff on $34 billion worth of Chinese imports, the media was flooded with slogans about standing up to China. Yet at the very same time, something entirely different was happening behind the scenes. Just 1 month earlier, on June 1st, 2018, MSCI officially began adding Chinese A-shares into its global indices. This decision forced hundreds of index tracking funds around the world to allocate capital into Chinese equities. As a result, China's weight in the MSCI Emerging Markets Index surged to over 40% by 2020. The outcome was striking. Between 2018 and 2020, at the height of the trade war, U.S. portfolio investment into China reached approximately $1.4 trillion. This capital flow peaked precisely when political tensions were most intense. Contrary to public rhetoric, major Wall Street institutions did not retreat. J.P. Morgan publicly stated it was continuing to invest in China, while Goldman Sachs emphasized that it had no intention of leaving the Chinese market. This apparent contradiction raises a deeper question. Why does capital move in the opposite direction of political narratives? To answer that, we must step back from current events and examine a recurring historical pattern, one that has governed every major reserve currency for more than 300 years. This article explores that pattern through 4 stages: the creation of debt-based money, imperial expansion through borrowing, monetary breakdown, and finally, the migration of capital to a new power center. From the founding of the Bank of England, to the collapse of Weimar Germany, to the end of Bretton Woods, and now to the present-day United States, the same mechanism appears again and again. Understanding this mechanism is essential, not for predicting the future, but for recognizing it while it is unfolding. Stage 1. The origin of the cycle. At the end of the 17th century, England faced a severe fiscal crisis. Continuous wars with France had exhausted the royal treasury, while public confidence in the crown was weakening. King William III urgently needed funds to sustain the military, but taxation alone was no longer sufficient. It was during this period that Scottish financier William Paterson proposed a radical solution: the creation of the Bank of England. In 1694, the public agreed to lend the government $1.2 million at an interest rate of 8%. In return, the newly formed bank received the exclusive right to issue currency backed by that government debt. The bank's subscribers, primarily wealthy elites, would collect interest on money that circulated throughout the entire economy. From its inception, the Bank of England functioned simultaneously as creditor and money creator. This arrangement marked stage 1 of the monetary cycle: money creation directly tied to government debt. With this mechanism in place, the government no longer needed to raise taxes immediately to finance wars or expansion. Public debt expanded rapidly, rising from 1.2 million to 16 million within just a few years and continuing to grow through successive conflicts. The primary beneficiaries, however, were not ordinary citizens. Financial elites earned steady returns from the nation's expanding money supply, effectively collecting interest on the entire economy. This system laid the foundation for modern central banking. Currency issuance was no longer anchored solely to precious metals, but increasingly to sovereign debt. While this enabled rapid expansion of state power, it also embedded a structural vulnerability. It encouraged unlimited borrowing. Debt was no longer treated as a temporary necessity, but as a permanent instrument of governance. At this stage, the system appeared stable. Britain built the world's most powerful navy, expanded its empire across continents, and transformed London into the global financial center. Yet beneath the surface, the system depended entirely on continuous debt expansion, planting the seeds for the next phase of the cycle. Stage 2. Expansion and overextension. Once the debt-based monetary system is established, empires enter a period of rapid expansion. In Britain's case, government borrowing financed wars, colonial expansion, and industrial growth on a global scale. By the early 19th century, after defeating Napoleon, Britain's national debt exceeded $885 million, surpassing 200% of GDP. Yet outwardly, the system appeared triumphant. The British pound became the world's reserve currency. International trade was settled in pounds. Foreign governments held British debt as reserves. Capital flowed into London, and Britain stood at the center of global finance. But this prosperity rested on an increasingly fragile foundation: debt layered upon debt. By the mid-1800s, the cracks began to show. British industrial output peaked and then declined relative to rising competitors such as Germany and the United States. The cost of maintaining a global empire grew faster than the government's ability to tax. Interest obligations mounted. The economy became dependent on continued borrowing simply to sustain existing power. While financial institutions continued to profit, the underlying productive base weakened. This pattern is not unique to Britain. Any system that relies on debt-driven expansion eventually faces overextension. When money creation grows faster than real production, inflationary pressure builds, currencies weaken, and social tension increases. Germany after World War I followed this same path. The United States in the 20th century also relied heavily on debt to finance wars and social programs. By 2024, U.S. debt held by the public reached 98% of GDP. Stage 2 is the most deceptive phase of the cycle. Growth masks fragility. Confidence replaces restraint. But the imbalance continues to compound until it can no longer be sustained. Stage 3. Monetary crisis. When a debt-based system reaches its limits, Stage 3 begins: monetary breakdown and loss of confidence. The clearest example is Weimar Germany. After World War I, Germany faced 132 billion gold marks in reparations. Rather than raise taxes, the government chose to print money. The Reichsbank monetized government debt, purchasing foreign currency at any price. By late 1923, the money supply had exploded. One US dollar was worth 4.2 trillion German marks. Prices rose hourly. Wages lost value within the same workday. The middle class was wiped out. This was not merely a policy error. German central bank officials understood that hyperinflation would eliminate domestic debt and dissolve the politically inconvenient middle class. When the crisis peaked, the solution required foreign capital. The Dawes Plan of 1924 brought American banks into Germany to restructure the economy. U.S. capital flooded in during the late 1920s. When the system collapsed again in the early 1930s, foreign investors had already repositioned, leaving behind political chaos and social collapse. A similar sequence occurred under the Bretton Woods system. After World War II, the U.S. dollar was pegged to gold at $35 per ounce, while all other currencies were pegged to the dollar. For 2 decades, the system worked. The United States rebuilt Europe and Japan, and the dollar circulated globally as the world's reserve currency. But as the U.S. financed the Vietnam War and expansive social programs through monetary expansion, the supply of dollars grew far beyond the gold reserves backing them. Foreign governments, most notably France, began demanding gold in exchange for dollars. On August 15, 1971, President Nixon suspended dollar convertibility into gold. The gold window was closed. Bretton Woods collapsed. The dollar became a pure fiat currency, backed not by gold, but by government authority and military power. Since then, gold has risen from $35 per ounce to over $3,000 per ounce, reflecting the long-term erosion of currency value. Stage 3 is defined by monetary excess, currency debasement, and the breakdown of trust. And once this stage begins, the final phase of the cycle inevitably follows. Thank you for staying with us this far. Not many people have the patience to reach this point, and if you're here, it likely means you have a deeper interest and a solid understanding of how financial systems really work. Take a moment to pause and reflect, because the next part of this video will connect everything we've discussed so far. And if you find the insights we share valuable, consider liking the video and subscribing to the channel. That support means more than you might think. It allows us to continue bringing you new perspectives and deeper, more thoughtful analysis on finance and global markets. Stage 4, capital migration. In every historical monetary cycle, financial elites do not remain passive. Stage 4 is defined by the relocation of capital to the next rising power, before the collapse of the existing system becomes obvious to the broader population. In the late 19th century, as Britain's financial system weakened under debt and declining industrial competitiveness, British capital flowed into the United States, financing railroads, steel, and industrial expansion. By the time the British pound officially lost its reserve status in the early 20th century, the financial architecture had already been rebuilt in New York. A similar pattern unfolded in Germany. During the Weimar hyperinflation, foreign, primarily American, capital entered the country to restructure debt and stabilize the system. Once conditions deteriorated again in the early 1930s, that capital had already repositioned elsewhere, leaving behind political and social collapse. Before the collapse of Bretton Woods, investors accumulated gold and alternative assets. When the dollar's convertibility to gold ended in 1971, those who had moved early preserved their wealth, while those holding currency absorbed the loss. Today, evidence suggests a comparable migration may be underway, this time toward China. On the surface, the United States and China appear locked in confrontation. On July 6, 2018, the U.S. imposed 25% tariffs on $34 billion of Chinese imports, formally launching the trade war. Yet, just 1 month earlier, on June 1, 2018, MSCI began adding Chinese A shares to its global indices. This decision forced institutional investors, pension funds, insurance companies, endowments, and sovereign wealth funds to allocate capital to Chinese equities. By August 2020, China's weight in the MSCI Emerging Markets Index had risen to approximately 41%, peaking near 43%. As a result, U.S. portfolio investment into China and Hong Kong surged from $516 billion in 2016 to $1.4 trillion in 2020, reaching its peak during the height of the trade war. Major financial institutions did not retreat. JP Morgan publicly stated it continued to invest in China, while Goldman Sachs confirmed it had no intention of exiting the market. These actions suggest that, behind political theater, global finance has already begun repositioning. At the same time, the U.S. financial system is displaying clear Stage 3 characteristics, mounting debt, monetary expansion, and declining discipline. This combination historically precedes large-scale capital migration. The United States today, signs of Stage 3. The United States increasingly exhibits the defining characteristics of Stage 3 in the monetary cycle. Public debt has reached historic levels. By the end of fiscal year 2024, debt held by the public stood at $28.2 trillion, equal to 98% of GDP. By 2025, total federal debt exceeded $37 trillion, surpassing 119% of GDP. Interest payments alone now exceed $1 trillion per year. At the same time, the Federal Reserve's balance sheet remains extraordinarily large. After expanding from under $1 trillion before 2008 to nearly $9 trillion during the COVID crisis, it still stands around $7.8 trillion today, far above pre-crisis norms. Such monetary expansion injects persistent liquidity into the system, increasing inflationary pressure and forcing the Fed to maintain elevated interest rates. The long-term consequences include reduced fiscal flexibility, rising debt service costs, and declining confidence in monetary stability. Demographic pressures compound the problem. Aging populations and entitlement obligations continue to expand unfunded liabilities. Social Security and Medicare commitments increasingly rely on government borrowing, further straining fiscal sustainability. Credit rating agencies have already downgraded the U.S. outlook, citing rapid debt accumulation and rising interest costs. While confidence in the dollar remains high, history shows that confidence often peaks shortly before reversal. Taken together, excessive debt, sustained monetary expansion, and structural fiscal imbalance, the United States now closely resembles previous reserve currency powers entering stage 3 of the cycle. China and the question of stage 4. China's financial markets have absorbed an extraordinary amount of global capital over the past decade. Index inclusion, institutional mandates, and strategic positioning by major financial institutions have all accelerated this process. The inclusion of Chinese equities into global indices did not happen by accident. Once MSCI incorporated Chinese A-shares, passive and semi-passive funds were compelled to follow. Capital allocation became mechanical rather than discretionary. As China's weighting increased, global portfolios adjusted automatically. Yet this capital migration occurred despite well-known risks. China maintains strong state intervention in markets. Regulatory decisions can be abrupt. Capital controls remain in place. Transparency standards differ from Western norms. Local government debt, real estate excesses, and demographic pressures continue to weigh on long-term growth. At the same time, geopolitical tension has intensified. The United States has imposed restrictions on outbound investment into sensitive Chinese sectors, particularly advanced technology and dual-use industries. Discussions around de-risking and partial decoupling remain ongoing. And yet, despite all of this, major Western financial institutions continue to expand their presence in China. This contradiction is central to understanding stage 4. Historically, capital does not wait for certainty. It moves when relative advantage shifts. Political risk is tolerated when the alternative, remaining fully exposed to a declining monetary system, poses a greater threat. The question is not whether China is risk-free. It is whether global capital views China as offering a better long-term risk-reward profile than an over-leveraged reserve currency system. History suggests that when capital begins repositioning at scale, it is responding to structural forces, not headlines. Across more than 3 centuries, the same monetary pattern has repeated with remarkable consistency. First, financial elites establish control over money creation through centralized institutions. Second, governments expand by financing growth and power through debt. Third, the system becomes overextended, monetary discipline erodes, and confidence begins to crack. Finally, capital migrates to the next rising center before collapse becomes obvious. From the Bank of England in 1694, to Weimar Germany, to the end of Bretton Woods, and now to the modern US dollar system, the mechanism remains intact. Today, the United States exhibits clear stage 3 characteristics: historically high debt, persistent monetary expansion, rising interest burdens, and declining fiscal flexibility. At the same time, global capital has already begun repositioning, quietly, systematically, and without regard for political theater. This is not a prediction. It is pattern recognition. No reserve currency lasts forever. No debt-based system escapes its constraints. And no transition announces itself clearly while it is happening. For investors and observers alike, the lesson is not panic, but awareness. Understanding where capital is moving, why it is moving, and what stage of the cycle we are in allows for better decision-making. Holding assets denominated solely in a weakening currency is a choice. Diversification across assets, regions, and monetary regimes is a form of risk management, not speculation. History does not repeat exactly, but it